I think Jerome Powell at the Fed sort of acknowledged as much yesterday. We are entering this stagflationary period where, as he put it, there's no risk-free route going forward. I can't think of a logical argument, a reasonable argument for why gold will decline significantly and stay down for any period of time.
And people won't panic out of their stocks and panic into gold and silver until they realize that gold and silver are vastly outperforming the S&P 500. We will get there. We might get there sooner than you think. Right now, this is not a panic. This is just the investment banks that are starting to look in the other direction and starting to think that maybe gold is an inflation hedge. And the secret really is gold is not an inflation hedge. It's simply money that isn't inflated, because money can't be inflated.
The global economy is shifting into a stagflationary phase where neither growth nor stability offers safety, and traditional investment strategies are being challenged. As central banks signal ongoing fiscal strains and the Federal Reserve acknowledges that there is no risk-free route going forward, gold and silver are emerging as resilient assets. Unlike equities, which remain vulnerable to declining earnings and shrinking multiples, the monetary metals are finding renewed demand as both institutions and private investors recognize their enduring value. AdrianDay, a seasoned fund manager and global markets commentator, points to the growing recognition that gold is not merely an inflation hedge but actual money, untainted by monetary dilution. Rafi Farber, known for his analysis on systemic risks and sound money, emphasizes that central banks' diversification away from the dollar is a structural shift, not a passing trend. With official reserves moving from 65% US dollar holdings down to 47.5% in just 5 years, the trajectory is undeniable. These reallocations will not only support gold, but also extend into silver, particularly as investors and institutions seek broader hedges against currency debasement. The combination of persistent deficits, weaponization of the dollar, and weakening confidence in fiat stability creates fertile ground for a sustained repricing of precious metals. The momentum is building, and the implications for both sovereigns and households are profound. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates, and enjoy the video.
We're clearly entering a stagflationary environment, and maybe the economy is not as weak as it might be, and inflation is not as runaway as it might be. It's not runaway inflation at all. But I mean, I think it's clear, and I think Jerome Powell at the Fed sort of acknowledged as much yesterday. We are entering this stagflationary period where, as he put it, there's no risk-free route going forward. So, I mean, one concern for the economy, for the stock market, would be that the economy declines faster than most people are thinking. For gold, can I give an ironic answer? What concerns me, frankly, Ivan, is that I can't think of a logical argument, a reasonable argument for why gold will decline significantly and stay down for any period of time. And that should make a rational investor nervous. You should always be able to come up with an argument, even if you don't agree with it, and even if you have countervailing arguments that are more powerful. I mean, I can come up with reasons why gold might correct for the short period of time.
Right.
But it's difficult to imagine. I mean, it could happen. Of course it could happen. But I doubt whether central banks are going to cease their buying of gold for any meaningful period of time. It always ebbs and flows, of course.
Mm-hmm.
And it ebbs and flows with specific countries. China was out of the market, wasn't adding for about 4 or was it 5 months?
Mm-hmm.
But then they came back. So different countries will stand aside for various reasons, for various periods of time. And so you could get central banks in aggregate standing aside. I don't expect that, both because of what the central banks themselves have said. The World Gold Council just put out a survey, last month, I think. They put out a survey of the central banks, and not one said they intended reducing their gold holdings in the next 12 months, and the majority said they intended increasing. Now, this is just what they said, but the intentions are clear. And frankly, also, if you're selling a dollar and increasing your gold because you're worried about the concentration of the dollar in the face of fiscal deficits in the US that just don't seem to be coming under control, and in the face of dollar weaponization, then I would argue that even though the dollar holdings in central banks have come down in the last 5 years from 65% to 47.5% was the last number put out last month. Well, I would argue the 47.5% is still too much in one asset. So that's probably got further to go. And of course, the more dollars you sell, some of it is going to go into gold. So I find it difficult so I think the central banks are going to continue to buy. Wealthy investors who are concerned about fiscal deficits, they're going to continue to buy. And North American investors who tend to buy based on the economic scenario, well, the economic scenario is shifting fairly rapidly towards the environment that is positive for gold: a slowing economy, lower interest rates, stubborn and higher inflation, and a lower dollar, which is what we've seen in the last month. That is a perfect environment for gold. So I mean, I do think on balance that we're going to continue to, and when I say gold, I'm including silver. I think on balance, we're going to see continued buying around the world, and also including in North America, into the metals. I think, as you probably know, back in the 70s and 80s, you did have a handful of central banks that owned silver, mostly silver producing countries.
Right.
Own silver. And then that sort of, I mean, I don't know that any central bank held silver, say, in the last 5 years. I may be wrong, but I don't think any of them did, certainly not in meaningful amounts.
Right.
So, yeah, I think this is a very significant move, because if you're a central bank, and as I say, virtually half of your reserves are in the dollar, and you're nervous about the dollar, apart from the dollar weaponization, you're nervous about the dollar anyway, especially as we move to a bipolar world. To the extent that the US loses its reserve status, then that means the dollar goes lower.
Right.
It doesn't have to lose it completely. We don't have to have China taking over as a reserve currency or anything at all. But to the extent that it loses it, the dollar goes lower. So if you want to continue to reduce the dollar, which is virtually half of your reserve assets, then you've got to think, do we want to put all of that into gold, or do we want to start diversifying? And I think we're going to see a little more put into euro, even though the percentage in the euro has gone down over the last 12 months. But we're going to see some go into the euro and maybe other currencies. I mean, there are some strong currencies around the world, like the Singapore dollar, but how much can a central bank put into currencies like this, like the Singapore dollar? But I mean, I think we'll see a slight but a perceptible increase in other currencies: Canadian dollar, Australian dollar, maybe the yen, but also into other hard assets, and silver, of course, will be the prime beneficiary of that. So yeah, I expect to see more of that.
Gold and silver continue to demonstrate why they are not simply hedges, but rather the foundation of sound money. As equities and bonds struggle under the weight of stagflation, institutional portfolios are beginning to shift, most notably with Morgan Stanley's pivot to a 60-20-20 model, allocating 20% to gold. This represents more than a portfolio tweak. It is a recognition that the traditional 60-40 balance is breaking down in an environment of rising yields, weakening currencies, and deteriorating confidence in fiat. The implications are profound. As banks and investment houses reduce exposure to government debt and equities, reallocating toward hard money, pressure on stocks and bonds will only intensify. This rotation sets up a feedback loop. Higher yields weigh on valuations, while metals absorb capital flows seeking refuge. The fact that gold is reaching new highs is not the end of the story, but the beginning of a structural realignment that could redefine asset allocation for decades. Silver, too, is positioned to regain ground relative to equities, with historical precedent suggesting its outperformance during monetary stress. The weakening labor market and backward-looking Federal Reserve policy only reinforce the case for further movement into tangible assets. Let's get back to the interview.
People won't panic out of their stocks and panic into gold and silver until they realize that gold and silver are vastly outperforming the S&P 500. We will get there. We might get there sooner than you think. Right now, this is not a panic. This is just the investment banks that are starting to look in the other direction and starting to think that maybe gold is an inflation hedge. And the secret really is gold is not an inflation hedge. It's simply money that isn't inflated, because money can't be inflated. Derivatives of money can be inflated by inflating their number over the money supply, which is the gold and silver supply. But gold is not an inflation hedge. It's just money. That's it. So what are we going to see? We're going to see interest rates go up as investment banks sell some of their debt, some of their treasury debt, and buy gold with the proceeds. And that is why interest rates are going to head up, and that's going to affect stocks negatively. And as their stock and bond portfolios continue to underperform the metals and the money itself, they will continue to sell their bonds and their stocks and pile into gold and silver over time. How much time? Not that much time. This is the beginning of the end as the mainstream recognizes the hole that it is in, as the gold and silver bugs wave to them from the ground level and encourage them to keep digging to get themselves out of their hole. Morgan Stanley CIO favors 60-20-20 portfolio strategy with gold as inflation hedge. This is by Mehnaz Yasmin, who I don't know what country he's from or she's from or whatever, but you have here these gold bars with those serial numbers. Isn't that beautiful? It's about gold. So here we're going to read the first three paragraphs and we'll get the point. September 16th, Reuters. A 60-20-20 portfolio strategy that includes 20% gold is a more resilient inflation hedge at a time when U.S. equities are offering historically low upside over treasuries and investors are demanding higher yields for long-term bonds. Morgan Stanley Chief Investment Officer Mike Wilson said on Tuesday, a 60-40 portfolio, which typically has 60% of its holdings in stocks and the remaining 40% in fixed income, which means debt, counts on moves in the two asset classes to offset one another, meaning one goes up, the other goes down. That's how it normally is, unless there's stagflation and the currency is imploding, which is probably what's happening now, which is why the CIO of Morgan Stanley is recommending 20% gold, because he sees the currency in collapse. He's not going to say that, but that's what he sees. Anyway, continuing with the sentence, with stocks strengthening amid economic optimism and bonds rising during turbulent times, that's how it's supposed to be with the 60-40, but it's not anymore because the currency is in collapse. So $333 billion, let's assume that all went into gold already. So we have other banks that are bigger, like JP Morgan and Bank of New York Mellon. I don't think that's bigger than Morgan Stanley, but whatever. You have big banks, and obviously all other banks in the world are going to follow Morgan Stanley eventually. So the 60-40 portfolio is going to become the 60-20-20 portfolio, and all the investment banks are going to invest, if they haven't yet, 20% into gold. And as they realize that stocks and bonds are both crashing, they will plow more and more dollars into the gold market, which is why gold is at all-time highs. It's not the only reason why, but you could ask me the question, is it time to sell? Is it that is silver, and gold, are they really outperforming the S&P 500 now? No, this is just the beginning. This is the silver to S&P 500 ratio. You can see here that from 2000 to 2011, silver did handily outperform the S&P 500, but since 2011, when we last hit $50, the S&P 500 has vastly outperformed silver, also gold, and we haven't even broken through a trend line, which would start at 2016 over here, tagged it in 2020, and it has not been hit yet. So this has been the rally from whatever this tiny number is to whatever this tiny number is, 0.007. And I've shown you this chart in other videos, and also I cover it on my Substack on endgameinvestor.substack.com, where the all-time high in silver relative to the S&P was like something like 0.44. And here, if you take that into account, this number of about 0.04 is barely registered on the graph. But here, really, this is really nothing. This is nothing. Because if you invested in the S&P 500 and only just bought the SP 500 ETF month after month, reinvesting dividends, you would have vastly outperformed silver since 2011, even since 2008, and even since I think you would have tied about 2006, whether you invested in the SP 500 or silver. You probably would have outdone silver with the S&P 500 because, S&P 500 will give you dividends, whereas silver won't unless you have a silver and gold account with monetary metals.
As you know, last week, the Bureau of Labor Statistics came out and said, oops, 911,000 jobs that we said were added to the economy over the last 12 months, ending March, didn't actually exist.
That's crazy.
I mean, this is just unbelievable.
That's crazy.
Yeah. And so anyway, the labor situation is clearly deteriorating. Even Powell admits now that he can't use the words very solid to describe the labor market. So as the labor situation in particular and the economy in general, but particularly the labor situation deteriorates, central banks are much more likely to err in favor of helping the employment picture, even at the risk of hurting inflation. So yeah, I think we're going to see that. My own view is that Fed probably should have cut 0.25% at the last meeting, or even before. But I think, couple of things. The last Fed under Bernanke, under Yellen, and then before that with Bernanke, have emphasized that they're data dependent. When you're data dependent, that means that you are backward looking. You can't be data dependent and looking forward. You are inevitably looking back. And when you're looking back, you have some reports that come out weekly. But when you're looking back, and the main thing you're looking at is new jobs creation, which is a monthly number, which is revised twice. And those revisions have been, for the last few years, very, very significant. You really don't have even the government's estimate of employment. Forget whether that's accurate or not. You don't even have a clear picture of what the government itself thinks about employment creation until 3 months after the event.
Oh, it's too late.
3 months late, your monetary response is going to be late. And I think that was clearly the case with employment. There were a lot of smart people, as well as myself, who for months have been saying that the employment picture is not as strong in the US as the headlines being new jobs creation and the employment number. Those are the headlines, those are the central numbers. But again, I've been saying for months now, but if you look under the hood, things were clearly not as solid as those numbers would suggest. And we've talked about this before. But when literally the majority of your new jobs are either part-time or government, that's not a solid employment picture.
No.
When the majority, something like 75% of the people who accepted a part-time job in surveys said that they only took the part-time job because they couldn't find a full-time job, that's not a solid employment picture.
No.
And all the Fed had to do was put some of those 400 PhDs who hang out at the Eccles building in Washington, put some of them onto reading the Fed's own beige book. I mean, all of the Fed regions put out what's called the beige book, where they talk to businesses in their region. They only had to read the beige book to find that most companies did not think the employment picture was as solid as the numbers suggest. And frankly, some of those people could have just sat down and picked up the telephone and listened to conference calls. obviously, when you listen to a conference call of a company, you're listening to what the company thinks, not what they're doing, or what they. But I would argue that in aggregate, listening to what CEOs think is going to happen to their own businesses in the next few months and year is probably a pretty reliable indicator likely to happen.
The shift we are witnessing in global finance is not a short-term anomaly, but the early stages of a much larger transition. Confidence in the old system of debt-driven growth and monetary manipulation is eroding. That erosion is forcing capital to seek safety, and history shows us it always returns to the same foundation: gold and silver. Unlike paper assets, these metals carry no counterparty risk and no promise that can be broken. As capital flows adjust, volatility across stocks, bonds, and currencies will likely intensify. For those who have positioned early, this volatility can be a tailwind, not a threat. The real opportunity lies in understanding that what appears to be a price move today is actually a structural revaluation in motion. Gold's strength and silver's setup suggest we are entering a period where patience and conviction will be rewarded. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.